Aloha, good afternoon today. If we're changing things around a little bit, it's Caron Davis of Caron Realty International. Today's I'm very, very thankful that Duncan found in his busy schedule to give us an update of the mortgages and what's going on, with all these, so many buyers out there looking. And of course, talk about having to change direction and be more creative. And as we know, Duncan is the owner of Infinite Mortgage, and he's the president. And he was a graduate of Punahou and Wharton Business College, two excellent schools when in your younger days, Duncan.
Yep.
And today's really what I want to do is really talk story about what's going on during your day of work and what you're seeing, because there's a lot of news articles out there and a lot of gloom and doom, and how are people pivoting around what's going on, just to give us some feedback on that and some insight, so people know that yes, people are actually still buying real estate even with the current market, what's going on.
Right. I think overall, we've got a situation where there's very low inventory. And with rates so high, I talked to some people that have been wanting to sell their house and move to another one, but they have rates in the threes, and now rates are in the sixes, and they don't want to sell the house and get a much higher mortgage rate. So that prevents some people from selling. So you got this very low inventory. There are people that still need to sell for various reasons, and there are a lot of buyers, a lot of people that need to buy because they're moving here, or you have this new household formation where you always have people that are reaching an age where they're going to be first-time home buyers. And we have the millennials. We have one of the biggest generations ever buying houses, and you have the baby boomers that are still living in their houses. So there's big demands just demographically, and not much supply. And meanwhile, you've got rates going up, prices have gone up quite a bit. So not as many new buyers can afford to buy, but you still have buyers, people that have to buy, and you still have sellers. So you always will have the activity. It is much less activity than last year when rates were a lot lower. You had a lot more buyers and you had more sellers. But with inventory and overall volume so low, things have changed. And mortgage rates are double or more than double what they were at the lows last year. And so it makes it a lot harder for people that are, especially first-time buyers. But there are a lot of things that we're doing now with buyers to make things a little better, alternatives depending on their situation.
It's interesting, even in the luxury market. I was talking to a client the other day, and he had locked in a rate for about 3.875 on I believe, a $2 million loan. And today that same loan's in the mid sixes. Yeah. And he really had to question whether he wanted to go ahead with the purchase. He still qualified, but that was tremendous more money at that kind of, loan value, of course.
Yeah, it makes a big difference on the monthly payment.
Big difference. And that kind of brings me to the question, what are you seeing? What are the programs available when you see these huge discrepancies? Someone looking at an under 4% interest rate, and then it jumps to 6%. What other programs are out there that maybe they don't go in this program, they go into another program?
Yeah, the national average for conventional loans hits 6.7% today, a multi-year high. I think it's the highest since 2008. So that makes a lot of people fear buying. They do have to pay a lot more for the monthly payment than last year. But there are alternatives. We have some lenders that have lower than average rates on conventional loans. But beyond that, we have some portfolio lenders. Basically, there's a conventional loan, which is loans that can be packaged up and securitized on an open market. And they meet the Fannie Mae and Freddie Mac guidelines. And the rates for those are pretty standard based on the mortgage-backed securities market. So there's a market kind of like the bond market where the rates are set. So it's not controlled by the Fed. The Fed, when they hike the rates, that doesn't mean that they're hiking the mortgage rates. That's one of the myths that people believe. They say, oh, the Fed's hiking by 0.75%. That means my mortgage rate's going to go up by 0.75%. It's not true. The Fed has made 3 straight 0.75% rate hikes since June, and that's 2.25%. Mortgage rates are up from the high in June, less than 0.5%. So instead of going up 2.25% like the overnight Fed funds rate has gone up. The mortgage rates haven't moved much at all. Well, they haven't moved up much from there. They did drop a little bit. They actually dropped the following day each of the times that the Fed raised by 0.75%. The Fed just did that again the other day, and they projected that they're going to do that again. So probably in November and December, they're going to do hikes again of 0.75% and probably at least 0.5% to get to their target in the mid fours. And then maybe one more hike is projected for early next year. But a lot of people, the experts, expect them to cut rates after that. The average historically over the last 50 years, the Fed starts cutting rates within 6 months from the last rate hike. So whenever they finish hiking the rates, late this year, early next year, 6 months later, they're likely to start cutting, especially as the economy slows. When they raise the rates so much, the economy slows down. They're really trying to get the inflation rate lower. And the long-term investors in mortgage-backed securities and in bonds, they want to see inflation low because their money that they're investing, they're going to get back up to 30 years from now. They're going to, the inflation makes a big deal because $1 30 years from now is worth a lot less than $1 now, especially if inflation is really high. But if the Fed is really vigilant about controlling inflation, which they have been and which they really are, that's really good news for the long-term bond investors because that means their money 30 years from now is going to be worth more than if they let the inflation run wild. So so the Fed controls the short-term rates. When they hike the short-term rates, that's the overnight lending rates to banks and institutions. It's not the same as mortgage rates. So that's one thing that people have to understand. It's not the same thing. The mortgage-backed securities market is an open trading market for investors and traders. And I think that the mortgage rates are not far from their peak. I wouldn't be surprised if we're in the upper sixes now. I wouldn't be surprised if it drops from the upper sixes and that's the peak or not much higher than that. I'd be surprised if it goes much above 7%. So I think we're near the peak of mortgage rates, but the alternatives that we're using, as I was mentioning, there's that open market for the mortgage-backed securities on conventional loans. A lot of banks and credit unions, local lenders have their own portfolio loans. They have loans that they keep in their own portfolio that meet their own guidelines, not the Fannie Mae and Freddie Mac national guidelines, but their own guidelines. In normal times, a lot of times those rates are higher than a normal conventional loan. Now they're actually lower in a lot of cases. So we're doing a lot more portfolio loans than normal. We're a mortgage broker. We broker both with national lenders and local lenders. And a lot of the local lenders we work with have portfolio loans that have better rates than the market. We have some that are, instead of being in the upper sixes, we have some that are in the fives or jumbo loans, even in the lower fives and even the fours on some that are not 30-year fixed. So some people are looking at different alternatives to a conventional 30-year fixed. They might go for a portfolio loan, which can be 30-year fixed, or it can be a 15-year or 15-year amortized over 30 or a 5-year ARM or a 7-year ARM. So there are a variety of different products that people can use to get a better mortgage rate. A lot of times they will come with higher points. So you got to pay a little bit more upfront, but if you're going to hold the loan for long term, it's likely that it'll pay off to pay a little bit in points to get a rate, especially if it's 1 or 2% lower than the market.
And thank you for all the valuable information. And it sort of brings to my attention, a lot of people's fear is based on not knowing, of course.
Yeah, right.
And when you explain what the cause is, that allows people not to be so fearful. And from there to have all these other options available. And by the sounds of it, it's so important to work with a creative mortgage broker right now. Because if you don't, you are going to probably put yourself in a position that's not the most advantage. Right. And so I think getting rid of that fear, going and getting the education on what's really going on in the markets is number one, what I'm hearing, what you're explaining to us. And number two, seeing what the options and programs are available out there.
Yeah, and a couple of other different products that people are using now. As one I think I mentioned on a previous call, it's called the all-in-one loan, which it's an adjustable rate product, and it combines a full service checking and savings account with a mortgage, and it allows you to put all of your income towards your mortgage balance, and then you have an interest-only payment for 30 years. It's a 30-year credit line, but most people pay it off in 7 to 10 years or even less, depending on their cash flows. So it's something that works really well. It's not as sensitive to interest rates because you're paying down the balance so quickly, and it makes a lot more sense in a higher interest rate environment like we have now, because you can't get a 3% mortgage now. So if you're paying an adjustable rate mortgage, it makes a lot more sense now than it did a year or two ago. So that's something that we're seeing more demand for that. And so for people that are familiar with velocity banking or sweep strategies, it fits in with that strategy perfectly, because people are able to pay out their mortgage a lot faster. It's a creative way, innovative way to treat your mortgage and be able to pay it off a lot faster and have the security in case something happens and you lose your job, the economy turns down. You don't have to make the full principal, interest, taxes, and insurance payment. You only pay the interest only for 30 years. Most people pay a lot more than that as they have their income come in. But when things turn bad, it's good to have that flexibility. They've never had delinquency. They've had that product for almost 20 years and never had any delinquencies, because the requirement for the mortgage payment is a lot lower. And the people that to qualify for it, you've got to be much stronger financially than some of the other loan types, because they want people that are responsible with their money. But it works really well with that type of customer. The other product that works really well in this market, we have a lot of population aging. You have a lot of people that are a little older with a lot of equity in their houses. So the reverse mortgages are much more popular now, and it makes a lot more sense when you have people that have a lot of equity, and if they need to move from their current place to another place, maybe they're downsizing, they can use a reverse mortgage, use that equity. You can buy with it, or you can refinance with that. And there's some big advantages to having a reverse mortgage using the HECM or the nationally backed reverse mortgage that generally in Hawaii goes up to almost $1 million, but it depends on where you are in the country. That type of a loan allows you to have a line of credit that grows, that compounds. If you make your payments and you have this line of credit, you don't have to make a payment at all with a reverse mortgage. But some people will get a reverse mortgage and they'll make their payments, and they have this line of credit that grows and it compounds with the interest rate. So it's one of the few, or maybe the only mortgage product that actually benefits the customer when the rates go up, because the line of credit increases. One of the biggest fears of retirees is outliving their money. If you have this line of credit that grows as you get older, that line of credit gives you a huge safety net. And so you have this big line of credit you can draw from if you need to as you get older, and you can use that for your retirement income. There's no tax on it because it's not income. It's you're borrowing from your equity.
So I know when reverse mortgages first started, 20 plus years ago, it was thought of a little more negatively. My father was in banking, but has it got a little more sophisticated, the product now, where it's a little more friendlier than it was years ago?
It's definitely a lot different today than it was 20, 30 years ago. It's much more regulated now. There are all these disclosure requirements and education requirements, and it's a much more useful tool than it used to be. Yeah, there's all these myths about the reverse mortgage because of decades ago, how it was. People don't lose their equity. You can actually, if you have this growing line of credit, if you go into negative equity, you never have to pay back that line of credit. You pass away, your heirs will still be able to buy back your house. They'll be able to keep that house in the family if they want to. But most times people don't want to keep the house in the family. I forget the numbers, but most heirs don't want to keep the same house in the family, but they can if they want to, and then they will, even if they go into negative equity using the growing line of credit, because of the mortgage insurance that's included with that product. They never have to owe anything. They don't have to. They're never going to lose their house. The heirs can buy back the house once the owner passes away. So there's a lot of flexibility, a lot of advantages to reverse mortgages that they didn't used to have. So it's a
that's
much
great.
better.
That's wonderful. Well, Duncan, thanks for today. We always just learn so much more every time we speak to you.
Totally my pleasure.
Thank you for your creativity. And just to finish, off our talk today, of course, we have Marianne's photos, and I'll just bring those up here on our screen. And of course, we have We have summer. Yesterday officially was the end of summer. You wouldn't think so with how hot it is out there. But for many parts of the country, fall is setting in. And what Marianne's done here is, the beautiful seasonal flowers that we experience. And here she has the angel trumpet flowers, make a statement no matter where they are. And we get to enjoy these flowers, though, all year round. And the monstera, although not a flower, the sculptural monstera is a real eye catcher and adds so much beauty to every garden throughout the year. And of course, the dramatic night blooming cereus is a magnificent nocturnal flower of a cactus enjoyed from June to October. And you were mentioning you have this in your garden, right?
Yeah, exactly. It's beautiful.
And I know they're outside Punahou School too. And oftentimes Doug would go and show Angus, our son, these flowers. I mean, they're so beautiful at night coming out. And then, of course, again, the beautiful plumeria that we enjoy, spring and summer months. And see you next year, she says, for our beautiful plumeria colors. But again, Duncan, thanks for being with us. So much appreciated. And I'll be talking to you this week about, pivoting a couple of other clients we're working with together. And have a wonderful weekend, everybody, and much mahalo.